Welcome back. This is Si-Wing Yi, and today's topic I'm going to talk about the uh, the current housing cycle landscape. And the reference I'm using is John Burns Real Estate Consulting. They are one of the nation's leading consulting company. They consult with all the major nationwide builders about the real estate activities, and they consult on many major uh, hedge funds and corporate Wall Street hedge funds and many major real estate companies. They did a lot of consulting. They've been doing it for a long time. So John Burns Consulting, I've been following them. They provide some very good high level real estate data, and today is no exception. So they put together a very nice big picture, picturesque housing cycle, which I will go over. So this it's a very interesting article, and the cycle that they created is a very easy to understand. So they'll give you some short-term perspective and even long-term cycle as to how the real estate is going to impact everyone, short-term and long-term. So without further ado, let's go over the first paragraph right here. The article stated that from the beginning of the pandemic, May 2020, until May 22, 6 or 7 months ago, we have experienced, as you know, some amazing historical pandemic real estate boom, price appreciation, skyrocketing of home prices, and the lowest mortgage rate in the history of mankind in the past 5,000 years. So the 2 year run-up has made a lot of people very rich, and for those people, they have the wherewithal to take action. So well, that's a little bit of my opinion. So yours truly also have participated in this 2 year historical run-up in real estate prices. So I'm a happy camper, as well as several hundred of our real estate investors, through my guidance, have purchased in this great run-up markets in the various part of the country. So, okay, let's go on with this paragraph right here. During the 2 year run-up, home prices have increased 1 to 2% per month, almost everywhere. Demand was unquenchable. Supply was extremely low or non-existent supply of homes, and home builders were recording the strongest margins in their history. Rental demand boom as well. And so John Burns Consulting decided to label, at that time, during the 2 year run-up, they have labeled these major markets that were the recipient of this run-up as growing or plateauing phase of their long-term housing cycle. So what they mean by that, what they mean by plateauing, also there are three categories, by the way: plateauing, slowing, and falling. So I will get back to this very nice picturesque housing cycle thing a little bit later. So let's define what John Burns Consulting mean by plateauing. Markets in the plateauing phase have seen significant capital investment over the past 12 to 24 months, and are now faced with limited volume growth and decelerating home price appreciation, leading to shrinking capital returns or underwriting becoming extremely aggressive in order for deals to pencil. And those markets that are plateauing are Atlanta, Charlotte, Indianapolis, Orlando, Tampa have experienced home price appreciation of epic proportion in a very historical manner. In my personal opinion, we would never can see in our lifetime, even beyond our lifetime, a 2 year skyrocketing of appreciation that we have seen these past 2 years. So furthermore, job growth during the pandemic prompted by buyers searching for affordability. And also, and then of course, the mortgage rates and slower economic growth have caused buyers to jump out of the qualified buyers pool or pause their home search until there is less uncertainty around the economy. That's what's going on recently. So Miami, New York have faced an urban exodus throughout the first 18 months of the pandemic, fueling out migration and a much slower labor market recovery. But the population has been returning lately to these major markets. Anyway, so the slowing cycle, the slowing aspect of the housing cycle, let's see how they define it. Markets in a slowing phase face alarming affordability levels, decelerating or even declining home price appreciation. What they mean by decelerating is home price gains has slowed to a single digit appreciation level. Does not mean the price has gone down. So you understand the vocabulary. Decelerating means that the price growth has slowed significantly, but have not really taken a steep decline, at least not just yet. Okay, so that's a slowing market. Furthermore, the immigration and job growth fueled by the proliferation of work at home policies allow these markets to really boom. And they are the markets are Dallas, Jacksonville, and Raleigh-Durham, which is the Sun Belt South and Southeast markets, which for years has been, in my opinion, has been home prices has been very affordable entry level wise compared to the other major markets of the U.S. But I'll go over more details later. So these markets have grown massively, not only the past 2 years, but over the past decade. They have this Texas and Florida and North Carolina have gone through some very consistent and very strong growth, job and population growth. And let me see what else. And as a result, a lot of those locals that have grew up in these areas, they are because they earn a lot less income than the people are migrating to these areas. So a lot of locals are very upset, and they are now the locals in these areas are completely priced out of home ownership, and year-over-year home price growth is decelerating rapidly lately, especially since the interest rate has skyrocketed in the past 9 months. So the construction volumes are pulling back from the previous high levels. So this fast-growing metros, smaller metros, in the South and Southeast is slowing for the reasons I just stated. So this means that they have achieved in the past from May 2020 to May 2022 these cities, these metros have achieved triple digit skyrocketing of home prices, but now they're cooling down. By no means they are crashing. Don't get me wrong. They are decelerating. So that means they have achieved like very modest appreciation, particularly in the past 12 months. But they're nowhere near bubble or crashing level, at least not just yet. So they are still doing fine. Little bit of bubble, little bit of correction, maybe 5 to 8% in most cases in this medium-sized metros in the South and Southeast. Does that make sense? Anyway, now this category of more severe, this housing cycle is falling, the category of falling. So John Burns Consulting has this to say: several major markets have now reached the falling phase of the cycle, characterized by flat or declining prices, limited capital investment, and shrinking housing demand. So these larger metros are in Chicago and Minneapolis and Austin, Texas, Sacramento, and Salt Lake City. These metros are falling quite, fairly significantly, but again, not really a crash yet. How do you define a housing crash? 20% housing reduction or more? It's debatable. So they are going through some correction, some price reduction, some some, yeah, those kind of things. So Austin, Sacramento, Salt Lake City, Chicago, and Minneapolis, standouts for in-migration and robust tech employment demand, job growth throughout the pandemic, but they have reversed course quickly, especially as a result of the sudden increase of interest rates since the spring has begun, from skyrocketing from 3.5% mortgage interest rate early part of this year, first quarter 2022, to right now, as we speak, around 6.63% 30-year fixed rate mortgage. So this uptick in interest rate has caused some of this pandemic boom town, if you will, in the Sunbelt areas to cool down, not crashing, but the word cool down. Phoenix and Riverside, same thing. And there were a number of significant speculative investment that drove prices very quickly during the pandemic. So, and then they also benefited tremendously from the industrial building development boom that has been cool. Sales are dropping, resale supply is skyrocketing, driving home prices appreciation down fast, with home values now falling month over month. Single family construction activity has pulled back, right, because of lack of demand. And many builders in these markets are reluctant to open new communities during a downturn. So on my other videos, I talked about that. A lot of these areas are in the western region of the Sun Belt, California, mainly. I'm going to talk about that more. So yeah, so let me go through. Let's go through this big picture. Okay, now you can see a little bit better. Again, let's review. Plateauing, or the areas are just their triple-digit skyrocketing appreciation has subsided, and you can't sustain 30, 50, 60% appreciation in the past 2.5 years. That's not sustainable. So they're cooling down to a modest deceleration of appreciation, a lot of like 3 to 5%, maybe 0%, maybe some slight reduction in certain neighborhoods. Atlanta, Charlotte, Indianapolis, Miami, New York, Orlando, and Tampa plateauing. So they have done well, but they're cooling off. All right, and then slowing, or like we mentioned once again, or the pandemic boom time in the South and Southeast mainly, although Boston are in this category, but most of it are in Texas, in Florida, Jacksonville, Nashville, Tennessee, and Orange County, California, slowing, and may have seen some recent price drops, like 5 to 8% perhaps, in this kind of market. Philadelphia, same. Portland, Raleigh, Durham, San Diego, Seattle, Washington, D.C. Again, this is only short-term correction, right? I mean, we all know, what you should know, that real estate is cyclical. But if if you stay in a house for at least 10 years, based on historical records, your real estate asset will grow if you invest, if you stay at your house at least 7-10 years or more. So again, I don't want all of you to have this short-term vision, but this is a very unique, challenging market, and the worst severity of the housing cycle, as described by John Burns Consulting, is that this category is falling. Now, the areas are in Austin, Chicago, Denver, East Bay, which is San Francisco Bay Area, which that's where I live. Okay, in San Francisco Bay Area, East Bay. I've lived here for 30 years, so I know about California real estate market. It's very cyclical. It grows tremendously over the years, but then when a correction occurs, it goes down pretty hard. But still, Las Vegas, same thing, right? LA, Minneapolis, Phoenix, Riverside, Sacramento, Salt Lake City, San Antonio, San Francisco, San Jose. So California are the most severely hit by this current environment, obviously. and of course Las Vegas and Phoenix, the Sun Belt, right, the western region of the U.S. Look, there are 400 markets, metros. There are 400 metropolitan. Okay, let me start here. Let me talk about this. There are 400 MSAs, metropolitan statistical areas in the country. Now, what I just described on this housing cycle, there are like give or take like 30 to 40 markets that we just went over. So we just merely like 10 to 15% of the 400 metros that are existing in the US. So the sky is not falling, it's not doom and gloom, right? There are many areas, there are many sub-markets all over the country they're doing well. They have not fallen because during the pandemic, they did not skyrocket in home prices 30, 40, 50%. So those markets are mainly in the Midwest, like Indiana, upstate New York, Michigan, Illinois, Tennessee, and Missouri, Ohio. Those areas are, they are very, very stable because during the pandemic, they have not gone up. They have not seen massive migration. They have not seen, robust economic growth like we have in the Sun Belt area, the western region of the U.S., California, Arizona, and Nevada. Those are, and Boise, Idaho. Those are. I'm surprised Boise, Idaho is not mentioned under the falling category. Boise, the big four: California, Boise, Idaho, Phoenix, Arizona, Las Vegas, and Austin, Texas. These 5 markets are the most talked about trophy market, if you will, pandemic boom town. So some people say they are pandemic bust town. But again, this is just a short-term correction. Yes, the falling category, the prices have gone down 10%, in some areas even a little bit higher, especially in California. But time will tell what's going to happen. If the interest rate maintains itself this coming year, some experts predict that the interest rate will come down to around 6%, maybe even 5.5% sometime next year in the second quarter of 2023. And I talked about that in other videos. But again, we're going through a very interesting correction, interesting bubble, if you will. There's crash is not in my vocabulary yet because there are still many homeowners right now. They have this quote locked in effect. They're not selling because they're sitting. 80% of the homeowners right now, they're sitting at a 4% 30-year fixed rate mortgage, and they have no incentive to sell or to upgrade to a 6 to 7% mortgage and paying higher price. So it just isn't any motivation. So the homeowners have massive amount of equity, trillions of dollars of equity. They're sitting pretty. They are the one that dictate the housing market, in my opinion. So again, it's not doom and gloom, but there will be some pain that we're going through. So let's see how the recession is going to happen, the job situation moving forward. The 2023 first and second quarter of 2023 will be very interesting. If the inflation is being, is subsiding, this means the Federal Reserve may decrease their interest rate to lower than 6%. Hopefully, then things could come back to normal. We don't know, but again, I don't think there's there's not going to be a crash. I don't think so. But time will tell. We'll see. I will keep you posted. So that's all I have. If you received a lot of value on this video, please smash the like button and also subscribe to my YouTube channel. I'm trying to increase my algorithm, so get more members. And thank you so much. And to see Win Yi, and now thank you for attending. And I will see you on the next video. Have a nice day. Bye-bye.